Hi everyone, myself Dr. Bharath, Assistant Professor, Department of Management, Kristo Jayanti University. Now in this session I am going to explain you the cost of equity, the most important in the component of cost of capital. So cost of equity, here the company and the investors are looking over the cost of equity. So, the cost of equity means whenever the investors how much are expected from the company profit or company revenues or dividends. So, that can be seen in the cost of capital. Cost of equity mainly two types. One is the mainly looking over the investment threshold. The investors are mainly looking over the investor threshold, means the return of a company requires to determine if an investment meets its return requirement. That means investors are investing in a company, they are expecting some return, a minimum return they are required from the company. So, that minimum required return must be on the equity finance investment to satisfy the investors. So, they are expecting, for example, when we are investing any risk free investments, we are risk free instruments are giving 7% return, but when you are investing any company, we are expecting more than 7% of required rate of return to satisfy the shareholders, because they are investing in these shares and they are getting a risk, because when the company makes profit, then only they can receive the dividend, otherwise they are not receiving any dividends or any return. So, they are facing a risk. The company must give satisfaction to the investors how much returns are expected from the company. So, the next one is investor perspective. You know that investors are facing a risk, because when company receive any money from the investors, usually they are after making investment of any projects, they are expecting a minimum return from the investment. So, the company how much paying the dividends in a year, or company how much uh, profits they are giving to the shareholders, that cost we call it as a cost of equity. So, the equity shareholders invest their capital to take a significant risk by owning the company shares. So, the majority only equity shares and preference shares are taking a high risk. So, in this scenario, so they are facing the risk, they are asking high in return also. The compensation isn't guarantee. Guarantee means when company makes profit only, then they are distributing the dividends, otherwise they are not distributing the dividends. It varies the marketing condition and the performance. If performance is very good, then only they can distribute the profit. So, what cost the company paying to the equity shareholders, that we call it as a cost of capital. We have different types of calculation of cost of equity. One is the CAPM formula. So, in this CAPM formula, the cost of equity equals risk free rate. RF means risk free rate. So, when you invest outside, when you invest any in instruments, you are getting a risk free rate. For example, fixed deposit or NSC certificates, there is no risk at all. So, how much risk you are getting from the instruments plus beta value. So, beta value measures the stock volatility. Higher the beta value, higher the risk. When company facing higher risk, investors also expecting higher return. Then multiplied by the expected market return. So, that is RM. How much the market is giving a return over the period of 5 years or 10 years. So, how much the market is giving the return. So, according to some reports, the NSE giving 20% of return every year. So, that is the market return. NSE stock index, the NSE, that is Nifty 50. So, 50 around 20% every year they are giving the returns. So, that is expected market return. So, next year how much expected we can from the stock market. So, if you use the CAPM model to calculate the cost of capital. So, what is the risk free rate? So, for example, government bonds, fixed FD rates or NSE certificates, these are risk free rate of instruments plus what is the risk of the stock. The risk, high relative stocks means the investors are expecting high. So you need to multiply, you need to add with the beta value, then what the difference between the market expected return minus the risk free rate. So if you simplify this CAPM model, so then you can easily calculate the cost of equity. So the next, so how is the cost of equity calculated? I told you one is a CAPM model, another one is based on the dividend capitalization model. So capitalization model, it gives you, so how much dividend they are paying with the each share. So how much dividend they are paying, expected dividend they are paying in the next year, and what is the current market value of the price. So it will give you the cost of equity. So how much cost they are paying per share, it going to be calculated using the second formula, that is dividend capitalization model. So dividend capitalization model is based on the dividends. So the formula is D1 divided by P0 plus G. D1 means annualized dividend per share, means next year how much dividend can investors are expected, and P0 means what is the current market price of the share, what is the current market price of the share, and you add what is the growth rate over the 10 years, what is the growth rate of the company. So that is G, growth rate. So if you use this dividend approach, so you can easily calculate the cost of equity. It's totally based on what is the expected dividend in the next year and what is the current market price. If you divide these two, you will get a what is the cost per share or equity. The why is the cost of equity is very important for investors and for companies. For investors, after investing any company, we are expecting how much dividend we can expect over the next year. It should be more than risk free rate. Maybe 7% is a risk free rate. We are expecting the return from the company more than 7%. So the cost of equity tells you the company how much they are they are giving the dividends to the shareholders. From company perspective, whatever the cost of equity, whatever the cost of equity they are paying, they are always analyzing the less cost of equity, because whatever they are receiving money from the shareholders, they are going to invest in a financial project. So after that, the cost of equity what they are paying, they are expecting more than the cost of equity. So the next one, what is the difference between the cost of equity and the cost of capital? The cost of equity is specifically to a one particular instrument, that is equity shares. The cost of capital is overall. So in the capital structure, what are the capital components are included? For example, one is the cost of equity, the cost of debt, cost of preference shares, cost of bonds, all put together we calculating the cost of equity. In cost of equity, cost of capital, in cost of equity we are calculating only the equity shares cost. In cost of capital, we are calculating entire capital structure cost. Next, the interpreting of this the cost of equity. So for example, what the numbers, for example, a company is having a 8.5 cost of capital. What is that means? Investors can expect a minimum return from a company is 8.5% return on their investment. After making an investment into a company, they can get minimum 8.5% of 8% of return every year. So that is what the cost of equity from the investors perspective. So the bottom line of this crucial concept is one is it's a fundamental concept for the investors, how much the company is paying. First we need to know, and critically insight for the investors expectation and minimum rate of required return, and we are going to take the decision to make an investment in the company or not. If company is paying more than risk free rate, then we can invest into that company. More they have pay, when their cost of equity is more, so the investors are ready to make the investment in the company. So the also automatically it will also increase the shareholders. Thank you for the session. So we'll meet you next with another topic.